Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Good to be here.
We are here on Christmas Eve, and we're navigating a volatile and holiday-shortened trading day. But today, our mission isn't just to look at the day's movement.
Right.
We are taking a deep dive into the source material that really defined 2025. The conflicting economic signals, the intense political maneuvering, and these historic market rallies that are setting the stage for what looks to be an even wilder 2026.
It's been a remarkable year for sure. And to guide us, we've pulled together a really comprehensive stack of reports. We're drawing heavily from deep dives across CNBC, Bloomberg, and of course Yahoo Finance.
And what are the key tension points you found?
Well, they're centered on the gyrations of the U.S. bond markets, the extraordinary multi-decade surge we saw in global commodities.
Incredible.
And critically, the profound strategic and geopolitical shifts that, reorganized entire supply chains, particularly in Asia and the global energy sector.
Okay, let's unpack this and synthesize those findings. We found three main threads woven through all the sources that I think truly encapsulate the year's chaos and success. First, we need to grapple with the increasingly divided Federal Reserve and the ongoing yield puzzle it created.
A big one.
Second, we have to dissect the historic explosion in key commodity prices. Gold, platinum, and copper reaching unbelievable heights.
Absolutely.
And finally, we will explore the dramatic corporate resets and global strategic shifts we saw across energy and tech.
Let's do it.
So let's start with the U.S. economy, because 2025 ended on this massive contradiction.
It really did.
We just digested that incredibly strong U.S. Q3 GDP data. That 4.3% growth was the fastest pace in 2 years, and it just dramatically blew past the 3.2% consensus forecast.
Right, and when the economy is that hot, the textbook reaction is for markets to immediately price in fewer rate cuts, push yields higher.
Exactly, but that's not what happened.
No. As CNBC reports, the bond market is signaling caution, maybe even some skepticism. On this shortened trading day, the benchmark 10-year Treasury yield actually dipped slightly down 1 basis point to 4.159%.
Wait, okay, for listeners who might not track the bond market daily, a basis point is just 0.01%. So that movement is tiny, but the direction is what matters here.
The direction is everything.
Why is the bond market moving away from this strong growth narrative? Are investors just calling the GDP data fake news?
Not fake news, no, but they're clearly pricing in immense uncertainty, and that uncertainty stems directly from the fighter inside the Federal Reserve, which both Yahoo Finance and CNBC have been detailing.
A fissure, yeah. The Fed cut rates 3 times in 2025, yet the internal debate now is sharper than ever.
It is, and leading that aggressive rate-cutting charge is NEC Director Kevin Hassett,
who the sources identify as a leading contender to succeed Jerome Powell as Fed chair next year.
Exactly. And he's insisting the Fed is way behind the curve on lowering rates.
His argument is pretty provocative, isn't it? Because he partially credits President Trump's recent tariffs for contributing a significant 1.5% of that Q3 growth.
That's the claim, a full 1.5%. He believes the economy is resilient enough to handle much lower borrowing costs right now. But the pushback is powerful.
Who's leading that?
Cleveland Fed President Beth Hammack. She articulates the counterpoint perfectly. Inflation concerns, made potentially stickier by those very same tariffs, still outweigh any labor market weakness.
So she's saying hold the line.
She believes the prudent course is to hold rates at current levels for several months, maybe until April 2026.
That political timing is just absolutely fascinating given the history of Fed independence.
It is.
President Trump has openly pushed for lower rates, and he's made it clear he intends to pick a new Fed chair in May 2026 who favors significant rate reductions. How aggressively do the sources suggest the market is pricing in that political shift right now?
The market is pricing it cautiously, but consciously. Despite the powerful GDP number, the prevailing sentiment, which you can see in the CME FedWatch tool data, shows investors expect the Fed to hold steady until April 2026 before they resume reductions.
So they're giving the Fed some time.
Yeah, you see the market giving the Fed time to try and sort out its internal divisions and wait for clearer data, especially since the recent government shutdown skewed some of the economic tabulations a bit.
So the caution is a reflection of respecting the political influence, but not assuming an immediate radical shift.
Exactly right.
Okay, so if we move from monetary policy uncertainty to real physical assets, 2025 was defined by acid inflation, specifically in precious metals.
Oh, absolutely. The Bloomberg and CNBC reports on this are just staggering.
Gold has crossed $4,500 an ounce for the first time ever. It's up over 70% year to date. That marks its best annual rally since 1979.
And the sister metals are doing just as well. Silver is now flirting with $72 an ounce, a historic level, but the real stunner has been platinum.
What are the numbers on platinum?
It surged past $2,300 an ounce, gaining over 150% this year. That is the biggest annual gain recorded since 1987. These metals are just moving in lockstep.
So why this synchronized, massive, historic spike? I mean, it's clearly not just one headline driving this.
No, it's a convergence of macro risk factors and very real physical supply issues. On the macro side, you have escalating geopolitical tensions, like the U.S. blockade of Venezuelan oil tankers, which drives investors towards safe havens.
Right.
You have the expectation of further U.S. rate cuts, which makes non-yielding assets like gold more attractive compared to lower-yielding bonds.
And the dollar.
And critically, the U.S. dollar index has weakened almost 10% year-to-date. This drives what analysts call the debasement trade.
The debasement trade, yeah.
If you're a global investor, it means you're choosing physical assets, which historically hold value over paper assets because you're losing faith in sovereign debt and the long-term value of government currency.
That makes perfect sense. People are retreating from the faith in government paper. But you mentioned physical supply issues, too.
Yes, look at platinum. It's facing a third consecutive annual deficit due to persistent disruptions in South Africa.
All right.
But there's an immediate unifying driver for all three metals: protectionism. Traders are actively stockpiling gold, silver, and platinum in U.S. warehouses right now to hedge against potential new tariffs stemming from a U.S. Commerce Department probe.
So they're trying to get ahead of it.
They want to front-run any future protectionist measures on critical mineral imports.
That tariff threat neatly connects us to industrial metals. Copper, which is the foundational metal for electrification and infrastructure, is poised for its best year since 2009.
It is. Bloomberg notes it's surged above $12,000 a ton, up nearly 40% year-to-date.
And the copper story is a classic supply-demand squeeze, right?
A textbook case. On the supply side, the year was just riddled with devastating unforeseen shocks. Deadly mine accidents in Indonesia and Chile, plus major flooding in the Democratic Republic of Congo. All of that severely constrained the global flow of the metal.
But isn't the AI demand narrative still partially speculative? I mean, how much of that copper surge is actual physical infrastructure versus future hype just baked into the market?
That's the critical debate in the market right now. The demand prospects are robust, certainly driven by mandated needs like power grids and new energy infrastructure.
Sure.
But the sources highlight the immense power requirements of the artificial intelligence industry as the key future driver. Investors are fundamentally betting that AI's continued build-out requires massive physical infrastructure.
New data centers, new power lines.
New cooling systems, all of which means massive, sustained copper consumption for the foreseeable future.
Speaking of companies reacting to these strategic pivots, let's look at BP. The CNBC stack pointed out BP's massive corporate strategy reset.
A huge one.
It's signaling a significant U-turn away from its previous green focus.
That's right. BP agreed to sell a 65% stake in its Castrol lubricants business to Stonepeak for $6 billion, valuing Castrol at over $10 billion.
And this is part of a bigger plan.
Yes, it's part of BP's broader plan to divest $20 billion in assets by the end of 2027. Experts view this as a clear signal of BP retreating and returning to its bread-and-butter focus: oil and gas exploration and development.
And this strategic pivot comes amid massive leadership instability. BP just announced its fourth CEO appointment in 6 years, Meg O'Neill, effective April 5.
And one advisor suggested this change might be the last piece of the jigsaw needed to finally stabilize the stock, which has consistently lagged behind its peers throughout all these diversification efforts.
Now, switching from the Earth's crust to the digital cloud, let's look at the incredible turnaround story for Google, which Yahoo Finance reported on meticulously.
It's an amazing story. Google started 2025 widely perceived as playing catch-up to OpenAI in the initial AI race.
What surprised me in the Yahoo Finance stack was just the sheer speed of that turnaround. Google went from perceived catch-up to having OpenAI CEO Sam Altman reportedly declare a code red emergency just to match Google's latest Gemini 3 models.
Wow.
What was the pivotal factor in their ecosystem win?
It was hardware integration and strategic partnerships. Their success is just underpinned by locking in major chip deals. They secured a significant expansion with Anthropic, who is now committed to using up to 1 million Google processors to power their AI software.
A million processors.
And plus, Google is reportedly in talks with Meta for chip supply as well.
So it's not just the software, it's the full integrated stack.
Precisely. CEO Sundar Pichai noted that Google Cloud Platform revenue grew a massive 34% in Q3, explicitly boosted by AI services uptake by over 70% of their existing cloud customer base. They have successfully positioned the model, the cloud, and the silicon together, which is proving to be the winning formula this year.
Okay, now we have to pull back to the global scale. When we look at global indices, emerging markets really had a strong comeback year, according to CNBC's analysis.
They really did.
The MSCI Emerging Markets Index surged around 30% in 2025, significantly outpacing the MSCI World Index, which gained just over 20%.
It was a stellar year for specific national markets. We saw spectacular gains in Greece, up 44%, and then Chile and the Czech Republic, both up around 50.8%.
So what's driving that?
Well, fund managers are claiming this setup is the most compelling in 15 years, and they're citing two key structural drivers. First, the weakening U.S. dollar down 9% year-to-date, which traditionally benefits EM assets.
And the second key factor was a structural change in China related to stock dilution, wasn't it?
Correct. For years, massive net issuance, that is, how much new stock is flooding the market, acted as a fundamental headwind for emerging market equities.
It's just constant dilution.
Constant dilution. Now, net issuance in China is narrowing precipitously. If that dilution drag disappears, it fundamentally changes the physics of the EM rally, turning a major headwind into a powerful tailwind that the market is currently celebrating.
Before we talk about the market highs and the soft power victories, we have to pause on something truly sobering that came out of the CNBC review of Asia's year.
Yeah.
It's a humanitarian crisis masquerading as an economic story. The worst year distinction was handed to the victims of a growing tsunami of cybercrime emanating from specific zones in Southeast Asia.
This is a devastating point. Criminal gangs operating with near impunity in Myanmar, Laos, and Cambodia are luring hundreds of thousands of individuals with fake job offers only to hold them against their will.
Enslaved, essentially.
They are enslaved to run multi-billion-dollar scam centers that target people globally. This organized crime operation is effectively generating a generational wealth transfer from Main Street America and Europe directly into the pockets of global syndicates.
It's a shocking story. And that dark reality exists alongside another major strategic development, the best year distinction for Chinese soft power.
Chinese soft power had a remarkable run this year. The highlights include the launch of the low-cost DeepSeek AI model back in January, which offered a serious challenge to Western tech dominance by lowering the bar for entry.
Right. And culturally.
Culturally, the ugly cute Pop Mart collectible, Labubu, became a global phenomenon, even making an appearance in major U.S. parades. And the animated film Ni Za 2 reportedly grossed over $2 billion worldwide.
So a combination of tech and culture.
A profound, diverse, and growing cultural and technological influence, yeah.
Finally, let's look at the remaining geopolitical friction points involving the U.S. On trade, the Trump administration announced a delay in imposing additional tariffs on Chinese chip imports until June 2027.
That delay is a critical signal. It attempts to cool immediate trade hostilities and effectively turns those tariffs into a potential bargaining chip for future trade talks, while also giving some much-needed supply chain clarity to U.S. firms.
Conversely, the administration ramped up pressure on international partners over digital governance.
Right.
The U.S. banned visas for former EU Commissioner Thierry Breton, the architect of the EU's Digital Services Act, and 4 anti-disinformation campaigners. The administration alleged they attempted to coerce American platforms into censoring U.S. viewpoints.
Yeah, for those unfamiliar, the Digital Services Act is the EU's landmark attempt to regulate digital platforms and moderate content. The U.S. action here, banning the visas of its chief architect and other campaigners, signals a massive international disagreement over who controls what can be said online.
And Breton's response.
He publicly called the action a witch hunt. It just highlights the deep and widening rift on global tech governance.
Okay, so if we synthesize this deep dive as we close out 2025, what have we learned?
I think we're in a market defined by significant asset inflation commodities, surging on real industrial demand, and macroeconomic expectations of a weaker dollar and lower rates.
Yeah.
We see geopolitical forces driving a strategic supply chain reorganization, evident in everything from critical materials to energy divestment. And all of this is set against a, frankly, dangerous backdrop of profound monetary policy uncertainty due to persistent internal Fed dissent and direct political pressure.
Absolutely. The tension between political aims, central bank independence, and hard market reality is the core theme heading into 2026. So here's the final provocative thought for you to consider, based on the resilience shown in the sources. Given that the U.S. achieved its strongest GDP growth in 2 years, that 4.3% despite the longest government shutdown on record, continued tariff chaos, and deep Fed uncertainty, what fundamental economic engine, beyond just AI and tariffs, is driving this underlying resilience? And how long can that foundation withstand the political turbulence expected next year?
It's a question of whether the underlying structure is stronger than the noise on the surface. We'll see you all tomorrow morning with new headlines from major financial magazines.